trending stock. So we know stocks don't just go straight up or straight down. When they're moving up, they have pullbacks and they have dips along the way. And when they're moving down, they have bounces along the way as well. So these dips are actually going to allow us as traders or investors to get into a bullish stock without chasing all the way up at its highs. And again, unfortunately, many people don't know the proper way to dip buy a stock. So if we take this example here, we could see the stock symbol SAVA here has a very strong move up in the morning. And we're looking at an intraday chart here. This is the 1 day, 1 minute chart. So that means that each of these candles represents 1 minute of price action over the entire day. But we see that there's a big spike up, and anybody looking to buy into a dip on this stock would probably be looking to buy somewhere in that boxed area where the stock is pulling back. And we do see that it bounces a little bit from that area, but it's a pretty weak bounce and it continues down lower throughout the rest of the day. So once you learn the strategy we're going to be talking about in the rest of the video, you'll see that this is actually not a good dip buy opportunity because there's not the specific pattern that we're looking for that would tell us that there is a good setup to buy the dip. So in other words, this would be a stock that if you were trying to dip buy, you would probably end up avoiding entirely because really once it has that first spike up and that first pullback, there's really no good dip buy opportunities. And what we want to see when we're looking to dip buy a stock is 4 main points. And these 4 main points are going to give us the entire pattern itself. So those 4 main points are A, B, C, and D. The A of this ABCD pattern is going to be the initial high, and this is going to happen after there is some kind of spike or some kind of upward move, showing us that this is a bullish stock in the first place and that it's potentially worth buying the dip and buying into that upward momentum. So once it hits that initial high and starts to pull back, that point at the high is going to be our point A of our ABCD pattern. The next point is going to be point B, and this is going to be the low point of that pullback. So from B, it's going to bounce back up a little bit. And then at point C, we're going to see a higher low. So we want C to be slightly above point B. And ideally from there, if the pattern is going to break out and continue upwards, what we'll see is the breakout at point D, which is of course a move over the previous high of point A. So what that is going to look like here, if we take this diagram at the bottom, you can see again we have our spike up, we have our initial high at point A, we have our low at point B, it bounces a little bit, and then we get a higher low at point C, and then it breaks out over point A, which gives us point D. And the way that we want to trade this pattern is we look to dip buy the stock at point C. And the reason for this is because we can then use that level of point B as our risk level to cut losses if the stock fails to break out to new highs. And this is very important because cutting losses is, of course, rule number 1 when it comes to trading stocks. You don't want to be stuck in a stock holding a large loss, and it's almost always better to simply cut your losses quickly and move on or look for a better opportunity to buy at lower prices. So because we know that there is no pattern that's going to work 100% of the time, even if you see this ABCD pattern forming, there will be times that it, of course, fails to break out and continue higher. So in that case, what we want to do again is cut our losses below that low point of point B. So if we take this diagram, for example, you can see that it looks to be a perfect ABCD pattern forming with our first 3 points, the A, B, and the C. So in this case, we would probably look to dip buy the stock at point C, expecting that it goes up and breaks out over the point A and expecting a further move to the upside. But again, because this isn't going to work every single time, I want to make sure that you're prepared to take losses just as much as you are to take profits as well. So right there on the red X, when the stock breaks below that low point of point B, again, that's where we would cut our losses and we would look to potentially buy at a new support level later on throughout the day, or we would simply move on from the trade and look for a better setup. You have to keep in mind that once the stock does break below that point B, it's no longer a bullish signal, and that could be the start of a downtrending stock. So if you are planning on rebuying later, it's important that you wait for a clear level of support to form, or for the stock to bounce back up and start breaking over some key levels of resistance. Now I have an example here on this page of the ABCD pattern, and again we're looking at the 1 day, 1 minute chart. So this is going to show us the entire day of price action, but each of these candles is again just representing 1 minute of price action. So I'm going to go ahead and play this. This is a little video. You can see early on in the day, the stock spikes up. So here's our first move up here, showing us that there is some upward momentum in this stock. We then get our peak up here at point A, and that's going to be the morning high. From there, the stock pulls back down. It hits a low down here of 35 cents, giving us our point B, and that is right before it starts to bounce a bit. And what we want to do is, again, let it bounce and then let it come back down and ideally form a higher low, which will give us our point C. And that's exactly what we see here. So we have our B point down here at 35, bounces up, pulls back down a little bit, and forms a new higher low, giving us point C. So in this case, we would be looking to buy probably about 36 cents per share for our point C, and we would be risking down here to 35 cents. So it's a very small risk in this case. And ideally, that's how this setup is always going to be. You're going to have a very clear level of risk. You'll know exactly when you should cut your losses if the trade happens to go against you. And when the stock does break out and the entire ABCD pattern forms, there's many times a huge profit potential with this pattern. And anyway, what we see here is once it bounces from that C point, we do end up getting a breakout above A, which of course gives us RD, confirming the entire ABCD pattern. And from there, it moves all the way up to, I believe, about 44 cents per share. Yeah, and then it starts to pull back down a little bit. But if we zoom out here, you can see the entire day just to show you the entire pattern. And in this example, this is a great example because it shows you that if we're dip buying the stock at 36 cents, which again is point C, our risk level again is only going to be down to 35 cents at point B, and our profit potential in this case was all the way up to about 44 cents because that's the high that it hit after it broke out at point D. So in this example, we would only be risking 1 cent per share, which is about 2.8%, with a profit potential of 8 cents per share, which is 22.4%. So with a $1,000 investment, you'd be risking about $28 to make up to $224. And that's the reason why this is such an effective way to dip buy stocks, because many times there is a much, much smaller risk than there is potential reward. And again, this can be a very highly accurate way to dip buy a stock. So I highly recommend when you're doing your analysis,